Hello and welcome. I'm Chris McManus from McManus Asset Finance. This is your business finance partner, a regular check-in where we talk through what's really going on in your business, how finance can support it, and what to watch out for along the way. Let's get into it. Hello and welcome to this week's episode of Your Business Finance Partner. I'm Chris McManus of McManus Asset Finance. I hope business is going well for you. In this week's pod, I'm going to be talking about one of the products that we do a lot of business with for our clients, and we get a lot of questions about the nature of the product, whether it's the right fit for businesses, and there's a lot of misunderstandings and confusion about how it works and if it's the right thing to do. I'm talking about Invoice Finance. Before I get into the sort of weeds of the product, I'm going to start talking about the problem that it tries to solve first of all, and then we'll explore exactly how it works, what the cost implications are, and whether it could be a good solution for you and your business. The main challenge most businesses face is one of cash flow. You may find that in your business, you do your job, you complete your service, provide your product to your customers, and then you're waiting to be paid. And sometimes you can be paid on delivery, and sometimes you can be waiting months for your customer to finally pay you for the work you've done. And that creates a cash flow pressure for any business. What Invoice Finance does is it sort of fills that gap of time between when you've invoiced for the work you've done and when you otherwise would be being paid. So if we think about a world without invoice finance, a business does its work, a haulage business, let's say, delivers for its client and invoices for the work it's done that week or the end of the month. And then they may be waiting 45, 60 days before they're finally paid. And in that intervening period, there is a gap of time where they're having to finance or pay for all of the costs of operation of their business, their staff costs, their vehicle leasing, their fuel, their tax payments, everything that it takes to run the business is being funded out of cash reserves if they have them, overdraft if they don't, director's own cash if needs be, while they're waiting to be paid. And the Invoice Finance product was created really to address that challenge. And in effect, what it does, in very, very simple terms, it will advance you, the business owner, the vast majority of the invoice amount as soon as you complete the work. So if we take a specific example of a £10,000 job that's been invoiced that ordinarily might take 45 or 60 days or longer to be paid. Well, when that invoice is raised for the work that's been completed, invoice financing will advance typically between 80 and 90% of that invoice amount straight away. So a £10,000 invoice, the business would receive between £8,000 straight away as soon as they've invoiced for the work once the work's been completed. And that cash injection then can be used to fund the business, help pay for staff costs, pay for fuel, pay for vehicle leases, etc., rent of premises, and all the costs associated with running the business. Now, some businesses have heard this 80%, this 90% advance, and are under the misconception that the rest of the money is lost. And that's one of the reasons why some businesses never pursue invoice finance as a conversation any further than that. The reality, of course, is different. The vast bulk of the invoice you still receive. The balance of the invoice is paid to you when your customer finally settles the invoice, less the cost of the facility. And we'll get onto that in a minute. But the key thing to understand with invoice finance is that as a tool, it's a very effective way of managing your cash flow for a business. When we talk to businesses about it, they're either using it already or they've heard about it but don't think it's the right tool for them. They believe that it's only used by businesses that are in distress. And this comes from a dated perception of the product. And it was for some time considered to be a finance solution of last resort. But this was at a time where overdraft facilities were far more common than they are today. And there were banking changes around about 20 years ago that had to do with the amount of money that banks had to keep on deposit and what they could lend out. To cut a long story short, overdrafts are an awful product for banks to provide, which is why they've started withdrawing them in large events. And the reason that they're terrible for banks is that if they provide a loan, an overdraft facility of £100,000, if it's only been used, say, for £10,000, the rest of the money is tied up. The bank can't lend it anywhere else. So an invoice finance facility does a similar job to an overdraft, but it's far more flexible from the bank's point of view on their balance sheet. So a lot of banks were moving away from overdraft facilities to provide invoice financing facilities instead. And from a business point of view, it makes really good sense because in the cost side of it, it's very little difference compared to an overdraft facility in terms of the cost. It provides you flexible facility and it allows you to grow and scale your business over time because the facility will grow if you need it to, if you get new contracts. And this is something a lot of people don't think about as one of the biggest advantages of invoice finance is the scenario where, let's say you're approached for a new contract or you want to bid for a new contract and suddenly you've got a new £500,000 contract for the business and the terms of that contract are that you're paid in 60 days. Now, for a lot of businesses, that might prove an impossible bridge to cover on the basis that the costs that you need to take on before you're getting paid would just be too much. You just don't have the cash flow within the business to do that. And so what invoice finance would allow you to do in that scenario is complete the work, raise your invoice and receive 80 to 90% of that invoice value immediately. You can then obviously pay your staff and all the costs we've spoken about before and essentially get that work that you otherwise wouldn't be able to. So in that sense, rather than it being seen as a cost that's taken out of your revenue, it's actually helped you achieve a revenue goal that you would have been unable to do without it. And so when we think about the cost of the facility, and this is something that people really always want to know, and it's not that complicated, and I'll break it down very simply here. An invoice finance facility, however you do it, will typically cost you between roughly 1% and 3% of your turnover. Okay, so in the sense of, let's say, a business with a 300,000 turnover, that figure is going to be closer to the 3%. So it's going to cost somewhere between, say, £6,000 and £9,000 for a facility for a business that's turning over 300,000 a year, and that's fairly standard across all of the providers in the market, to give you a ballpark idea. But then if you're turning over £1 million plus, that cost will drop closer to the sort of 1% of turnover mark, and it varies obviously from between 1% and 3%, but it's a lot lower as a percentage the higher your turnover goes because there's more competition for that sort of business. And so when we think of that side of it, the cost isn't excessive in terms of borrowing comparables, and you as a business then need to think about a really important question if you're considering whether to go down the road of using invoice financing or not. And that's this: you are not a bank. Your business isn't a bank. If you were, you're in the wrong game. You don't lend money. You shouldn't do. But if you're waiting to be paid for work you've done, you're acting like a bank. You're providing your customers with an overdraft facility, for want of a better phrase. You're providing them credit. And if you're out for 30, 60, 90 days payment, you're effectively funding their cash flow and you're not charging them anything for that. And the question I would pose to you is, should you be? If you're providing your clients the ability to not pay you for several months, it's not unreasonable to think about possibly charging them for that. Because if it's going to cost you to access that money, maybe if you're able to, you can pass some of that cost on to your customer. Maybe 1 or 2% of your invoice amount. You just increase that. And that would cover the cost of your invoice finance facility, whilst at the same time allowing you the ability to have access to the bulk of your funds straight away. The product really works well with businesses that are in a position where they have regular clients that do have these set payment structures, and they're not going to change. As much as we would all like our customers to pay us as soon as you've done the work, the reality is that that's not the case. We're in a market where if you aren't able to offer them credit terms, they'll simply go elsewhere. So in that scenario, you kind of got to bite the bullet on these things and accept that there is going to be a cost associated with growing your business and maintaining your cash flow if you're waiting a couple of months to be paid. And invoice financing as a product is the perfect tool for that. There are different types of invoice finance. There's 3 main ways of financing your invoice. They've got similar names, but they're slightly different in terms of how they operate. And so we'll just go through those with you now. So invoice finance is a catch-all term really to cover the 3 main products that you'll likely come across. One is factoring, the next is chocks, and the last one is invoice discounting. Now, factoring as a facility is a disclosed facility. And what that means is that you raise your invoice to your customer as normal, but the payment details on the invoice are disclosed to your customer as being a bank account of the invoice finance company that you're working with. So whichever company that might be, it'll have their bank details on there, and your customer will make payment to those bank account details when they finally decide to pay. But you, as the customer, as soon as you raise that invoice, you're able to draw those funds from the invoice finance company straight away, up to the percentages we spoke about. The middle tier product is called CHOCS, and CHOCS, CHOCS, stands for Customer Handles Own Collection Service. And that works exactly the same as the factoring facility. It's a disclosed facility, but unlike the factoring facility, you would manage your own debt collection. You would ring up your customers to pay you, and you would manage that process. And with the factoring facility, typically the invoice finance company would do the credit control for you. They'd be ringing your customers to get you paid. And the thing to think about there is the cost of the invoice finance facility is made up of two primary costs. There's a service charge for having the facility in place, and then there's a discount charge, which is for want of a better phrase, it's the interest rate that you're being charged for the length of time the invoice remains unpaid. So the sooner your customers pay you, the less of a discount charge you're going to receive. And so you may want to be in a position either to get yourself paid more quickly, or simply because you want to manage your clients in a way that you're more comfortable with, to do your own credit control and debt chasing. And that's an option for you if you have a CHOCS facility. And it can also be slightly cheaper than factoring, as the invoice finance company aren't providing the credit control service for you. And then the third option is invoice discounting, and this is the confidential facility. So this would be, you would raise the invoice, and on the invoice, the payment details are a bank account name in your name. So your customers don't know you're using an invoice finance facility. It's completely confidential. And if that matters to you and your business, then you can go down the road of that option. And of course, there's no credit control facility there, because it would be strange for somebody else to be ringing up chasing your invoices. So you'd manage that yourself. And so that product, again, can be a little bit cheaper than the factoring facility, but it is something that tends to be offered only to companies with slightly larger turnovers, probably $1 million plus generally, in order to get access to that type of facility, because the finance company have less control, if you like, of the invoicing process and the payment process as such. So as a product, it's used across all sectors, haulage, recruitment, engineering, manufacturing, construction. Believe it or not, there are several lenders that will operate in the construction sector, fewer than in other sectors, in fairness, due to the complexity sometimes of contractual arrangements. But construction companies do use that, and they use it very, very well and successfully in their businesses. And so to sum up, really, the key I would ask you to think about and consider with invoice financing is within your business is, what is your cash flow challenge at the moment? If you don't have one, if you're sitting on piles of cash and you can manage your business comfortably without needing to chase payments from your clients, then it probably is a product that would be unnecessary for you. If you're using an overdraft facility, or if you find that you have cash flow pressure points at times through the year and you're not using invoice finance already, it's certainly something to think about. We can offer you the ability to review the market without cost, without obligation, and then we can put together some options for you to consider and to see if any of those could be a good fit for you and your business. I would recommend, whatever you decide to do, is that you look to engage with a brokerage rather than approach banks and lenders yourself. And the reason I do this is very much the same advice you'd give to someone who was going into a courtroom without a solicitor. As brokers, we know the market and we know the questions to ask, and we know which lenders to approach that are most suitable for each business industry type, stage of development, the type of geography they're in, and their likely needs. And we can pinpoint with great accuracy 3 or 4 funders that are going to be a great match for you. And what we can then do is put together some options from each of them. We can approach the lenders on your behalf and negotiate hard with them to get you the best possible deal they will offer, because of course, as we produce so much business for them, they're keen to ensure we keep passing them business. So that means that we get preferential pricing, and we can help deliver a better offer all round for you. And then we'll work with you to guide you through the process, answer any questions, and make sure that we end up with a proposal and a deal that is going to be a perfect fit for you and your business moving forward. So that about wraps it up for this brief dive into the world of invoice financing. If you've got any questions at all, please get in touch with us. Call the office on 0330 027 0433, or you can email info@mcmanus.finance, and we'd be delighted to talk to you about the benefits of invoice finance and answer any questions you might have. Thank you for listening. I've been Chris McManus, and this is Your Business Finance Partner. This has been Your Business Finance Partner with Chris McManus. If you're a UK business owner and would like to discuss your business finance options, please call us on 03300 270433 or email info@mcmanus.finance.